So every public company out there, they've got to tell a story about their financial health. But have you ever wondered how they actually value the trillions of dollars in assets they hold? Well, the answer lies in this rule book called IFRS 9, and today we're going to pull back the curtain and demystify it.
I mean, just think about it for a second. A huge global company might own everything from simple bank loans to really complex derivatives. So how do they decide what each one is worth? And how does that number affect the profit they report to you, to me, to all the investors? It's a massive puzzle, and the stakes are enormous. And that's where IFRS 9 comes in. It's the global accounting standard that's designed to cut right through all that complexity. Its whole purpose is to make a company's financial story more relevant and, believe it or not, a whole lot easier for people like us to actually understand.
Okay, so here's our game plan. First, we're going to look at the why behind all these rules. Then, we'll dive into the specific paths for different kinds of assets and liabilities. And finally, we'll tie it all together and see how these different models are all working towards one single goal.
First things first, before we get into all the nuts and bolts, we really need to understand the big idea here. I mean, why does IFRS 9 even exist? Well, the answer is surprisingly simple. It's all about telling a more truthful story. You know, this whole system is really built on this one core principle. The ultimate goal of all this financial reporting, it isn't just to check a box or follow some rules. It's to give people, investors, lenders, you name it, information that actually helps them make better decisions. If the info doesn't make a difference, then what's the point? It's just noise.
So, to make sure this information is actually useful, IFRS 9 boils everything down to two fundamental questions for every single financial asset a company owns. If you can get these two things right, the entire system just clicks into place.
And here they are, the two big questions. On one side, you've got the business model test. This is all about intent. Is the company holding this thing to collect payments over time, or are they planning to sell it for a quick profit, or maybe a bit of both? Then, on the other side, you have the cash flow characteristics test. This is about the asset's basic nature. Is it a straightforward loan with simple principal and interest, or is it something more complicated? All right, let's put this into practice. We'll start with the most common types of financial assets out there, debt instruments. We're talking about things like bonds, loans, and all those receivables. Okay, now this might look a little complicated at first glance, but don't worry. This is the exact decision map for debt assets. See how it starts at the top? It's really just a series of yes or no questions that apply those two big tests we just talked about, the business model and the cash flows, to guide you to the right answer down at the bottom. In fact, we can boil that entire flowchart down to two essential steps. First, you check the nature of the cash flows. And second, you figure out the business model. Let's break those down a bit more.
That first step is this critical gatekeeper called the SPPI test. All it's asking is this: are the payments you're going to get from this asset just simple principal and interest? In other words, is this a basic loan? If the payments are tied to something else, like the price of gold or a company's stock, it fails this test right away and goes down a different path. Okay, so if an asset passes that SPPI test, we move on to the business model. And here's a great way to think about it. If your model is hold to collect, you're like a car collector who buys a classic to keep it forever. You measure it at what's called amortized cost. If your model is hold to collect and sell, you're more like a collector who also deals. You care about the car's long-term cost and its current market value, that's fair value through OCI. And if your model is just trading, well, you're a day trader, flipping cars for a quick profit. The only thing you care about is that daily market price. That's fair value through profit or loss. Let's run through a quick example to see how it works. Say a bank makes a simple 5-year loan. First question, does it pass the SPPI test? Yep, the payments are just principal and interest. It's a basic loan. Second question, what's the business model? The bank plans to hold it and collect those payments. So that puts it squarely in the hold to collect bucket. The result, it gets classified at amortized cost. Simple as that. So that covers debt, but what about equity? Shares of stock. These are a totally different animal. See, unlike a loan, a stock has no contractual cash flows. There's no guarantee you'll ever get paid a specific amount, which changes everything. And because of that fundamental difference, the decision path for equity is way, way simpler. Since there are no contractual cash flows to check, that whole SPPI test we just learned about, it's completely off the table. The game has totally changed.
For equity, the decision path is much more direct. The first question a company asks is, are we holding this stock to try and flip it for a quick profit? If the answer is yes, then it gets measured at its daily market price. Simple. But if it's a long-term strategic investment, the company gets to make a crucial choice, a one-time only decision that it can never, ever take back.
And this is the really clever part. When a company makes that choice for a strategic investment, any changes in that stock's value, they don't hit the main profit number that everyone looks at. Instead, they go into this separate bucket called Other Comprehensive Income, or OCI. And, this is the key, they stay there. They are never recycled back into the main profit figure, not even when the stock is sold. And why do they do this? To stop the wild swings of the stock market from making the company's core business performance look super unstable. Okay, so we've covered assets pretty well. Now let's flip the script and look at the other side of the balance sheet, financial liabilities. This is all the money a company owes, like bonds they've issued or loans they've taken out from the bank.
So here's the decision map for liabilities. And at first glance, it looks pretty simple, right? For most liabilities, there's a very straightforward default path. But stick with me here, because there is one fascinating and honestly slightly mind-bending exception to the rule. So, for most of what a company owes, the rule is easy. They're measured at amortized cost. But a strange situation comes up for liabilities that are measured at fair value. What happens if the market suddenly thinks the company itself has become a lot riskier? What does that do to the value of its debt? This brings us to this really counterintuitive idea called own credit risk. Let's break it down. Say a company's financial health gets worse, and the market thinks there's a higher chance it might default on its debt. Well, the market value of its debt will actually fall because it's now riskier to hold. That specific change in value, the part that's just due to the company becoming riskier, is what we call own credit risk. All right, let's zoom back out for a second. We've just walked through 3 distinct models, one for debt assets, one for equity assets, and one for liabilities. They might seem different, but they are all carefully designed to work together, all pushing toward that one single unified goal, telling a more useful and truthful financial story. This summary chart here gives us a fantastic bird's-eye view of the whole system. Now, notice how for all 3 categories, if something is held for trading, it defaults to the same place, fair value through profit or loss. That makes sense. But now look at the differences, especially in how OCI is treated for assets versus liabilities. This is where the real logic of the standard shines through. And this slide right here, this highlights what is probably the most subtle but important difference in the entire standard. Just look at how OCI is handled. For a debt asset, the value changes that build up in OCI are eventually recycled into the profit and loss statement when it's sold. But for a strategic equity asset, they are not. And that one difference exists for a very specific reason, to tell a more truthful story, one that protects that core profit number from the long-term, unpredictable swings of strategic holdings. Which brings us right back to that mind-bending idea from liabilities. So if a company's debt is measured at fair value, and its credit rating gets worse, the value of that debt actually falls. And on paper, a fall in a liability looks like a gain. So could a company actually report a profit just because it became less trustworthy? Well, IFRS 9 says no, absolutely not. It prevents this weird outcome by forcing that specific gain into OCI, keeping it away from the main profit number. It's a complex answer to a complex question, all in the service of telling a better and ultimately a more truthful financial story.